Welcome, dear traders. Asian stock markets opened higher on a Monday, while stocks in Australia, New Zealand, and mainland China rose by 0.1.2%. Japan's Nikkei tested a new 30-year high early Monday. The main drivers were central bank decision on interest rates, both actual and expected. First of all, it's the US Federal Reserve. Judging by the latest statistics, its aggressive monetary policy seems to be bearing fruit. Last week's reports confirmed that the US labor market was cooling and the price pressures were easing. However, the regulator is not considering a rate cut, at least not this year. There will be no early reversal of monetary policy next year either. Speakers from the US Central Bank, led by Jerome Powell, have warned against this in their comments. As for FedWatch Tool shows 100% of the markets expect to pause at the December 13 and January 31 meetings. With the rates held at the current levels, already 28% of market participants believe that meeting on March 20, the regulator will cut its interest rate by a quarter of points. Soft inflation data and weak economic activity have fueled hopes that the Federal Reserve will pause its rate hikes. They also fueled risk appetite among investors. This led to a sharp weakening of the US dollar last week. As a result, the greenback has already depreciated by 2%. On a Monday, the downtrend not only continued but dragged the greenback to its lowest level in 11 weeks to 103.7. Nevertheless, analysts believe that it's too early to say that the US dollar has lost its power. After all, the US regulator is ready to quickly change its policy and watch inflation from the sidelines. Much will depend on the US economic data. The global geopolitical turmoil forces the regulator to refrain from long-term plans. Therefore, the fundamental backdrop for the US dollar remains bullish. The US dollar's price hovering within the bearish range of 103.5 and 104 points and may reverse at any moment, especially since the US real estate data was quite optimistic. However, the US dollar index has so far disregarded these reports and continued to lose ground for the second session in a row, mainly due to falling treasury yields. For example, the 10-year Treasury note, which perked at 4.7% on Monday, November 13, has fallen below 4.4% today. As a result, the greenback fell across the board against the G6 currencies during today's Asian session. Its sell-off was most active in the pairs with the antipodean currencies and the yuan. Asian investors seemed to revive after the People's Bank of China capped the lending rates at the November fixing. The decision was in line with the market expectations and came against the backdrop of China's uncertain economic growth and persistent yuan deflation. In particular, Japan's economy is also defined by persistent deflation. It has been going on for several decades, and now there is a unique opportunity to defeat it. This was announced today by the country's finance minister. Sunichi Suzuki believes that Japan's economy is showing clear signs of such changes. Nevertheless, the Japanese regulator is constantly pursuing an adaptive monetary policy. However, he has redefined the government bond yield ceiling of 1% as a free ceiling rather than a hard limit. This means that the Bank of Japan will not buy an unlimited number of government bonds. Moreover, the main criterion for its intervention in the foreign exchange market is not the weakness of the yen, but its high volatility. This means that currency intervention may not be as imminent and necessary as the market thought. With this outlook, the yen is likely to continue to weaken. Indeed, it remains the worst performing G10 currency this year. However, today in Asian trading, the yen strengthened to 148.70 against the US dollar, and the Japanese currency hit its highest level in more than 5 weeks. The yen's rise was particularly impressive following optimistic comments from the head of Japan's finance ministry. In addition, the falling US Treasury yields and the US dollar favored this scenario today. As a result, the dollar-yen pair moved in the Asian session within the daily range of 148.60 and 150.00. In addition, technical indicators show the potential for bearish continuation towards the support level of 147.20. The Australian dollar, which was supported by China's interest rate decision, also hit new highs. Early Monday, the Aussie rose to its highest level in more than 3 months. The price reached 0.6560 and was trading higher within a daily range of 0.6501 and 0.6565. However, the Aussie's technical indicators are mostly pointing to a bearish trend, and the US dollar's weakness may be short-lived. Therefore, the Aussie may face a strong resistance around the psychological level of 0.66. Meanwhile, there are no major economic reports scheduled for today. In the domestic news, investors will be looking for latest minutes from the Reserve Bank of Australia's meeting tomorrow. At its November meeting, the regulator raised interest rates by 0.25%. And the main reason behind this decision was inflation. In Australia, inflation turned out to be more stable than expected a few months ago. However, the further movement of the rate will now depend on the incoming data, including the economic reports that will be released this week. So what about New Zealand dollar? It continues to grow for the second session in a row. At the beginning of Monday's trading, its price took advantage of the weakness of the greenback and increased within the boundaries of 0.5983 and 0.6040. As a result, the Kiwi closed the Asian session near 0.6028 and then rose even higher to 0.6044. That's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below and see you soon.